Hey everyone, welcome to the KE Report Daily Editorial on Thursday, July 24th, chatting with our good friend Mike Larson. Mike is the editor-in-chief at Money Show. We'll recap the recent Money Show Conference in Vegas and tie that into what we're seeing in markets, bull markets all over the place, but a big focus being on commodities. So that's one thing I heard from a guest earlier this week. Mike, was Daryl Fletcher, the commodities trading desk over at Bannockburn Capital Markets. He was, I believe, the first time at your Money Show conference in Vegas, and he was mentioning on an earlier interview just how excited people were and how much they were noting the commodities doing very well. Not just gold, because gold actually is kind of flatlined for a little bit, but all the other commodities, mostly metals focused, that are doing really well. So, Mike, maybe just a quick little overview of that Vegas show. And did you notice the same bullish mentality around commodities or metals broadly?
Yeah, I mean it was a great show. We had a great crowd. We had a lot of some new speakers, guys like Daryl. We had Larry McDonald from the Bear Traps Report and a few others. It was nice to have everybody together at this point in time where we've gone through this crazy market environment where the world looked like it was going to end during Liberation Day, or I guess Liberation Week, if you want to call it that, back in April, and then the remarkable resurgence since then. I mean, I always open the conferences by kind of setting the stage on what I'm seeing, and one of the charts I had in there was just about how this was the fastest recovery and strongest recovery from a 15% decline, at least in the S&P, basically ever. So, you had a total panic freak out that was followed by an epic rebound. And now, here we are. We're at this point where people are seeing some of the worst of the trade and tariff concerns get put to bed, as deals are getting signed, or at least, we're moving away from that ridiculous 25, no 50, no 100% tariff kind of stuff that freaked everybody out back in April. And now, tariffs are going up, but they're not at these ridiculously punitive levels. It looks like they won't be. Ultimately deals are being made. So I think in that environment, I wouldn't call the crowd ebullient. I wouldn't say everybody was, dog piling into metals mining or things like that, or even the market as a whole. But I would say, people were fairly encouraged. They're looking for ideas. And, I think that's the right approach. I mean, this is a market, before we came on record, we were talking, this is a market that, with the exception of maybe the last 6 weeks, where you've seen a little bit of divergence, where big tech's been rallying and other stocks have been held back, there's been a little bit of deterioration in breadth. Overall, it's been a market that's been, pretty good for a lot of different sectors. I mean, it's not like you just have the Mag 7 working like you did a few years ago. You've got a lot of sectors working. You got financials, you got, tech, you've got industrials, you've got materials, mining. I mean, shoot, of course, I was just calling the Global X Silver Miners ETF 61% year to date. I mean, that's not a very bad return from where I sit. So commodities are doing well, and even within the commodity space, it's gone from being sort of a safety to central bank accumulation gold type trade that was more dollar insurance and some of those other factors, to now you've got other things involved. You've got copper, you've got silver, you've got platinum, palladium. So in that kind of environment, if you're an investor in the space, that's exactly what you want to see. I guess the one sort of fly in the ointment is that oil isn't doing much. That part of the market, or commodities market, is just sort of chopping wood, not really going anywhere. But all in all, in the metal space, what started with precious metals mostly has broadened out to, hybrid precious industrial like silver, and even more industrial metals overall like copper. And that's what you want to see. If you're a bull in the sector, that's precisely the kind of thing that can encourage you. It's not something that means euphoria, but it is something that means, look, this is not just one thing, one metal, one part of the market. It's a lot of different parts pulling together, pulling the sled. And that's exactly what you want to see if you're a bull.
Yeah, it's a true bull market, really almost across the board, unless you're talking about the US dollar, which is the only thing going down on the screens. But when you look at the general markets, just a couple months ago, Mike, we were the narrative that people were selling the US to diversify overseas, and the overseas markets have done well, but you look at the Nasdaq and the S&P, they're at all-time highs, so somebody's buying the US markets. And when you look at what's happening in the resource space, some of those are Canadian companies, some of those are US companies, but like you said, whether it's gold, silver, copper, palladium, platinum, even critical minerals, we've seen a lot of action in the resource space and the cryptocurrencies.
Bitcoin made an all-time high. We've even seen a resurgence of the meme stocks we were talking about off mic, where even things like Krispy Kreme donuts today or a day or two ago, Kohl's was up. And so are we at the potential of such a risk-on environment? You said that it wasn't ebullient, but it seems pretty ebullient to me. It seems like there's a lot of risk-on pedal to the metal trading in there. Are we at risk of getting into that 2021 frothy area, or how are you seeing the lay of the land overall?
Yeah, I mean, I think you're right to point out in the very recent history that we're back to the sort now it's Krispy Kreme, now it's Kohl's, now it's GoPro, Beyond Meat. Good Lord, I mean, talk about blast from the past kind of names, but that yes, that always is a little concerning. I think you got to keep that in mind. You got to maybe have one eye sort of halfway tuned to what's going on in terms of market breadth. It'd be nice if it was a little broader in terms of participation. But all in all, I mean, those are more like pockets of issues versus, and you got to weight sort of the pros and cons, or if you're an accountant, you got the little T-square thing going on. Everything else looks really darn good. There's certainly a lot more things in my mind that are in the pro column than in the con column for this market environment. And if we were seeing, and I would say if you go back to sort of when the meme stock stuff was going on, you also had all those idiotic, money losing SPACs and money losing tech companies that were coming public and so on. It was very much that sort of dot-com 2 type environment. I don't see a lot of that going on. I don't really see just, we're not getting flooded with IPOs. We're not getting, a different money losing company coming public every day like we had for a while there. And just in general, it's a bullish environment that doesn't seem like it's too bullish, and I wouldn't say sentiment's all in. Now, if we get past the August 1 deadline and all of a sudden you've got, not just the rumors that we're seeing as we're recording this, that the EU has come to a deal, we just had Japan reportedly sign a deal, we had deals in Indonesia and Philippines and so on. If all this stuff happens, we get to August, the start of August, and we've priced in a lot of optimism and all these tariff deals happening, then we enter sort of a seasonally weak part of the year, August, September, where you kind of say, well, what next? So I can see a scenario where we sort of run into this, on these headlines, and then everybody's like, geez, have we gone too far? We digest some of that. We pull back in August. We pull back in September. So I don't want to say it's just from now through the year end, pedal to the metal. We're just not looking back. But I think overall, again, the things that I watch that sort of tell me, we got to be a little more careful, or the things that are sort of indicators of credit stress and irrational exuberance, whatever, they're not really flashing bright red to me at this point. In the case of credit, everything's sort of okay, doing solid there. In case of IPO activity, okay, okay, nothing too crazy. It really is just that meme stuff, which is sort of, that's a sideshow. You can play in that if you're an active trader. Hey, have at it. You might if you don't have a sports betting app on your phone, or you're not in Vegas like I was last week, and you want to scratch that itch, go for it. But I mean, I don't think your average investor on the street or average retiree is messing around, is putting all their money into that kind of sector. Which if you go back to like .com in 1999, people were just throwing money all across the board, hog wild into tech and that huge bubble. I don't think we're at that stage. So watch it. But in general, I've been a bull for quite some time. I've been a little more selective this year. I've tried to zero in on different themes, things like metals, things like foreign stocks, and so on. Those are working very well. And, I don't see a reason to sort of change that tune just because that seems to be working. And I think it's probably going to continue to work. And, you just mentioned foreign stocks. I mean, the EWJ is up again nicely today, the Japanese ETF. Some of these smaller markets have underperformed, but Europe's done very well, and I think that kind of just tells you this is not just a U.S. story, and I think overall that's a good thing.
Yeah, that's another good point. You can make the argument that, yeah, some of the European markets have actually outperformed the U.S. markets and rebounded even faster after the first Liberation Day. And one other thing we've seen in the resource sector too is money filtering down into the smaller stocks. So again, money is more risk on. One theme that we've seen in markets really post-COVID is retail investors simply doing more. It's what we're even seeing in bank earnings that have come out recently because of higher trading volumes, but also retail investors that came in pretty quickly after the first Liberation Day and bought markets. At Money Show, at your conferences, have you noticed retail investors not so much being the so-called dumb money anymore, that they carry a bit more weight?
Yeah, I think that's a great point because yes, you always get, the old sort of, crusty types on Wall Street will say, oh, those retail investors, they don't know what they're doing, blah, blah, blah. You know what? Retail investors these days are a lot more educated, I think. There's a lot more information out there they can rely on. Obviously, not to toot our own horn. I mean, we're trying to do our best to educate retail investors and make sure they're making smart moves with their money. But even not just what we do, what's available online, what a lot of investors these days, especially younger investors, are doing when it comes to social trading, bouncing ideas off of other people on apps and in Discord groups and things like that. It's not just sort of a solo man or woman's game anymore. There's a lot of ways you can learn. That's powerful. And I think, if retail investors, if they didn't panic, which the evidence seems to suggest they didn't, while hedge funds, lost their marbles in April, that's been the smart play, right? And that's why, just as we're chatting, I pulled up a couple quotes. I mean, Coinbase Global up 63% year to date. Robinhood Markets up 173% year to date. These are the kinds of things that show, yeah, trading activity is picking up, but, it's picking up and it's, proven to be the smart move to pay attention, to be trading this market and to keep your long-term money parked versus panicking. And that's been the right play.
Well, Mike, at the Money Show, you have a range of speakers that cover a range of topics. Were there any markets that were covered that you thought were particularly interesting to highlight that maybe don't get as much airtime, but were still in relative strength?
Well, I mean, I do think crypto is increasingly of interest to people. I mean, it's worth noting, again, I'm not some sort of, deep in the weeds crypto guy personally. I have a little exposure, but nothing crazy. Historically, I've been more into metals for that sort of part of my portfolio. But I will say that, it's getting more acceptance. People are listening. Institutions are dipping their toes in. So more investors, even that might be outside of your sort of traditional prior crypto investors, are paying attention, and they're making money off this. So good for them. I would also say some of the technology, the Palantirs of the world still attract a lot of interest. I mean, the AI story, we did a pre-event on Monday before the main conference kicked off on Tuesday, and it was focused all, on sort of the AI subspace, and not just the names that you think of, the Palantirs of the world that are directly exposed to AI, but the power companies, the data center type companies, all of the other firms that are sort of benefiting from the ocean of money being thrown at AI investments by big tech. There's a lot of interest in that part of the market and profiting from that trend. And again, I would still say, it's bullish, but it didn't smack to me as, blow off toppy or, oh, this is, March 2000, you got to get out kind of attitude. More like, yes, I want to participate. Yes, I'm looking for ideas. No, I'm not, when you have conversations with people, it's not like, I got, 90% of my portfolio in Palantir. You're not hearing that kind of thing. And so I think, again, to me, it's healthy bull market action without being wildly over the top bullish.
Mike, where's all this money coming from that's moving international markets, that's moving domestic markets, that's moving the commodity markets? I ask that because we keep hearing that the money could come out of the bond markets because those are so huge, but we haven't seen much move in interest rates. So where is all this money coming from if you had to assess it?
I think part of it is probably that you mentioned the bond market. I think part of it is that 60-40 mentality is really changing. And again, it's sort of a glacial process, but it's, less, I just want to own 60% stocks, 40% bonds. It's now maybe I want to be 60-20-20 with commodities and alternatives making up that other bucket, or 60-20, 10-10, commodities and alternatives. I mean, you're seeing, I think, at the institutional level and again in the individual level, after a few years, and really it's been almost a half decade now where that sort of 60-40 thing hasn't worked the way it quote unquote should. I think you're seeing that shift. Larry McDonald did a very good presentation on hard assets and the rotation into that, and just how we may have broken that sort of long trend of disinflation and 60-40 being your best friend as an investor and so on. And his thesis was basically like, that 40 bucket is going to change. And that kind of makes sense to me. I mean, I don't think we have to be some runaway 1970s inflationary environment, but if you are in a situation where just people are going to be looking for some more debasement protection, more inflation protection, modest inflation, not runaway inflation, then where are they going to find it? They're going to find it in things like hard assets. And so I think that doesn't just appeal to me sort of from a mental standpoint. I think it also seems to be what you're seeing in terms of how people are reallocating portfolios.
Yeah, there does seem to be a definite interest in hard assets to complement their digital assets. So there is that movement. I wonder how much you think at these shows or interacting with the audience, just the awareness to the commodity sector has come up from the 2020 supply chain issues that came up during the pandemic have fast forwarded to governments around the world, not just the US, but in the EU and China, really making critical minerals something that's important. But we've seen a lot of executive orders just out of the Trump administration on mining itself. We've seen things like the proposed tariffs on copper. We've seen things about nuclear. There's 4 executive orders just on nuclear power and the uranium and domestic power. Do you think all of that, where the media then covers it, has more generalists going, oh, yeah, these are the building blocks of society. I guess we do need to put some focus on securing our domestic raw materials. Do you think that's playing into it at all, Mike?
Yeah, I think that's a good observation. I mean, in a more multipolar world versus just, hey, it's US versus China and that's it, or the old Cold War model where it's US versus Russia. I mean, you're sort of in this multipolar world. You're in this situation where because of what Trump's doing, whether you like Trump or don't like Trump, the practical impact of what he's doing is it's making other nations be sort of more self-sufficient, realizing they can't just rely on US largesse or U.S. giving this umbrella. So that's why you have, countries that are trying to do more resource security, countries that are trying to do more supply chain near shoring or onshoring and so on. You're right. It's a sort of long-term sort of glacial type shift versus something that happens overnight. But yeah, I mean, I think that's part of it. I think that countries know that they have to have more exposure to this stuff. They have to secure more of the building blocks, of society and production and manufacturing and so on, versus just be able to rely on partners that, for various domestic political reasons, and again, not just the U.S., but China and elsewhere, are just less reliable than they were in the past. So that's certainly a part of it. And, again, the sort of big picture long-term, or super long-term trends take a long time to play out. So that's why I think you are seeing some of that pivot out of bonds into assets, out of some of these sectors that do best in disinflation and deflation to stuff that does better in modest inflation or in some cases stronger inflation type environment. So, I don't hate bonds here after the sell-off we've had, but I definitely, think that thesis of allocating more to hard assets makes a lot of intellectual sense. And certainly if you look at what it's doing in your account, it's paying off in dollars and cents too.
Oh boy, is it ever. But on that theme then, why is energy, old school energy, oil and natural gas lagging this, I guess, shift more towards commodities?
I think that the supply shortages that we had, the OPEC cuts that we had, and so on, I mean, those are kind of going away. So, plus in some markets, you don't have gangbuster growth. You do have, an easing in growth without a recessionary environment. So, in that kind of situation, I think just the supply demand picture is a lot more balanced. It has frankly been pretty balanced for a while. So, that's why, you get into an environment where oil is not crashing, but it's not surging. It's chopping around. I mean, this sort of home base level that we've been in, 65 to 75 bucks in the US for WTI, has been pretty persistent for quite some time. And, that doesn't have to be a crisis or anything. I mean, obviously, if you own energy stocks, it's going to hold you back a little bit. But in terms of for the economy and for sort of long-term planning purposes, I mean, I was speaking to one oil company today, they said, look, of course, we'd love higher prices, but this at least the lack or the reduction in volatility allows us to plan more. It allows us to, basically be able to focus more on the long term and not have to, plan a project at X price and then have it, be at Y price, $20 higher or lower a month later. So, I think the industry can deal with it if we, get stability without a real sort of falling off the table type environment.
Mike, just one observation in talking to you for so many years is when we first started talking to you, you were writing the Safe Money Report, and things were really around guarding against, potential downturns in the economy or downturns and, using dividend paying stocks and using smart money strategies. It seems like in general, the nature of what people consider safe, when you think about bonds, when you think about dividend paying stocks, when you think about gold, when you think about the dollar, some of those relationships have changed, especially the greenback and bonds. Are you seeing that play out when you talk to audiences about protecting your money because you have a good focus on that in your past and your present?
Yeah, no, you're absolutely right. I mean, again, what you use as an asset, what you use amongst asset classes and within asset classes like stocks, what you use to protect yourself or, to provide that downside protection has shifted. I mean, I still like solid dividend paying companies that are in the right industry and so on. I think a dividend focused approach works. I just think there's times when you want to be tilted more towards safety and that defensive type stuff, and times when you want to just be tilted towards more growth and and sectors that are more cyclical and all of that. And it just so happens that really since 22, I've kind of been in that latter camp where I just think that that bolder approach with your investing, not only or really makes sense from an economic standpoint, makes sense from a market standpoint, and the kinds of catalysts that have sort of made me run for the hills or really batten down the hatches. Going all the way back to the housing top in '05 or kind of where we were with the SPACs and the ridiculous IPOs back in 2021. I don't think we're in that kind of environment. So why invest as if we're in an environment when the conditions have changed? I certainly down the road, if I see the kinds of things that I've seen in the past at what I consider to be big pivotal moments from risk to safety, I'll be back on that roof, that proverbial rooftop shouting about it. I just don't think that we're in that situation now.
Yeah, Mike, you've done fantastically, really switching as the market has dictated from bearish to bullish. And right now, look, there's a lot of bull markets out there. There's a lot of breakouts happening. It's the time to embrace it. Make money during bull markets, and hopefully you can pivot again when markets do shift into those safer strategies to conserve your gains and maybe still add to some of them. But right now, bull markets in a lot of different sectors and a whole new interest in commodities and metals in particular. Very interesting to hear what you've been hearing at the recent Money Show conference. Again, Mike Larson, editor-in-chief at Money Show. I'll post a link in the show notes to the Money Show website. Mike, thank you as always for your time. Great chatting with you.
Great. Thanks for having me on, Corey.